In this week's update, the rotation away from tech appears to be complete. Is this the buying opportunity? And we'll take a look at the Bitcoin chart. My name's Garry Davis, and as always, this is general advice only, and please remember to like and subscribe the video. 2 weeks ago, I outlined why this selling out of tech and growth stocks would not be a major reversal point. It would prove to just be a transient event. And for valuable perspective that I think will help you deal with periods like we've had to endure the last 3 weeks, it's probably well worth revisiting the video that I did back on March 14th. And there's a link below this video to that. And in particular, just the first 10 minutes or so of that video, I think it's a really valuable perspective on what we've just been through. Now, this week, I want to examine the forces that cause this type of seemingly irrational selling behavior. Many price movements in a lot of the favoured stocks that have done very well were pretty ugly, but the volumes were generally light. The VIX hardly moved at all, and it just felt like it just wasn't going to last all that long. And certainly we saw a tentative reversal on Thursday night in the US, and then we saw very good follow through on Friday night in the US. So it all just sort of lines up quite nicely. All right, let's just start initially with looking at the VIX index. Sorry. Yep, the VIX, there we go. Okay, so you can see this is the VIX index over the last 3 months. And you can see that for the last week or 10 days, we did get a bit of a blip in the VIX, got up into the mid 20s in early March. But over the last part of March, when the selling was the heaviest, the VIX just fluctuated up and down above and below 20 by only about a point or so. So this is not the sort of behaviour that you would normally expect to see if this was going to be major selling. So that was one of the key points. One of the other key points too, when you looked at individual stock charts, were that the volumes weren't particularly high either. They were just normal, and in many cases they were actually lower than normal. So let's just take a look at this perspective on the XLK, which is the overall technology index. So short term, all sectors, no matter what it is, go through periods of rotation. It's just simply healthy profit taking that kicks in for a period. Stocks advance too far, too fast, and you get some profit taking. And with the amount of leverage that we've got in the system these days, the profit taking can often be quite violent and a bit scary. But you've just got to keep it in perspective as to what it is. It's just profit taking. It's not a major reversal in trend. The catalyst this time was the perception, and it is very much the perception that interest rates rising means that's bad news for technology stocks, and that it's virtually a 100% relationship. One goes up and the other one goes down. This is actually, when you look at the mathematics and you look at the correlation coefficients, this is actually a falsehood. There is no consistent correlation for the majority of the time. So you want to just throw out everything that the media has been telling you in the last month. It's just not true. There are some brief periods when interest rates go up and tech stocks go down, and we've just experienced one of those brief periods. There are also periods when interest rates have gone up and tech stocks have gone up as well. But the vast majority of the time, there is no correlation, and that's what the mathematics clearly shows. So coming back to reality, when you've got an expanding economy, as we've got now, with profits rising, with tech stocks in particular, and rising very robustly, then what stocks do you expect are going to do best? Just think about it logically. And the answer is that it's those that can grow their earnings the most. And you find that in the most aggressive sectors: technology, consumer discretionary, and some other sectors along those lines. Now, the other factor is that bond yields are rising. No one can argue that. And so that means that bonds are being sold. If yields are going up, then the bond prices are going down. Bonds are being sold. Money is coming out of the bond market. Where does that money go? And a good slice of it has got to go into equities. Now, in the last few weeks, that money has probably gone into the non-aggressive sectors of the economy, but that doesn't mean that it's going to continue. That's just the market dynamics that applied within that period. Now, if we look at seasonality factors, again, the maths is very clear. Aggressive sectors tend to have relative weakness in the third month of every quarter. Now, that is largely driven by when earnings seasons occur. So the strongest times are leading into earnings seasons for technologies, leading into earnings season, and the month or 6 weeks after earnings season. They tend to be the strongest periods, and then the third week of the month tends to be the weakest. And the maths show that the difference is actually quite significant. It's a very large difference. And then on top of that, we also had post-options expiry week, which is always prone to manipulation by market makers. And this time the market makers had an absolute field day because there was, to a degree, a bit of fear and panic in the market, and they really exploited that to their own financial gain. And finally, there are so many new, inexperienced traders in the market using leverage, following things on social media, that it's inevitable that they're going to get exploited, they're going to panic, and they're going to sell out at the worst possible time. So I think all these market dynamic factors came together to deliver us a period that was probably a bit more volatile and violent than otherwise needed to be the case. It could have just been a burst of mild profit taking and that was it. But look, that's what the market dynamics are these days. But the important thing is, and again, why I think it's important if you go back and look at the video that I did 2 weeks ago, is if you keep a clear perspective on what's actually going on, you don't get caught up with the media hype that it's all over for tech stocks and interest rates are going up, so tech stocks are going to go down, and then you make crazy decisions where you sell stocks that are looking in really, really good shape. And let's just look at a couple of them. These aren't recommendations obviously at all, because they're just a couple of hundreds and hundreds of stocks. But this is Corning, which is up to their armpits in the 5G infrastructure build out around the world. They'll be and are being a huge beneficiary of that, and also the provision of a very toughened glass into smartphones. Look at what happened to the price of Corning during the last few weeks of selling. It actually went up, and look at how it finished the week, Thursday and Friday. It's a very, very powerful trend. And they're the stocks you want to look for, the ones that actually don't get sold off as heavily. Let's look at another one. This is Qorvo. It's a semiconductor stock. There's a shortage of semiconductors around the world that looks like it's going to continue for quite some time. And stocks like Qorvo are going to be enormous beneficiaries of the dynamics in the semiconductor market, particularly into electric vehicles. So again, these aren't recommendations, they're just a couple of observations, but look at what the share price of Qorvo did during the last month. It really just went sideways and then had a very strong move on Friday night. So these are all important indicators. Let's take a look at some of the spreads. So one of the spreads that I keep an eye on constantly, and this really is the ratio between the Russell 1000 growth stocks and the Russell 1000 value stocks. And you can see if we pan back, we've had a lengthy period from really 2017 where growth stocks outperform value stocks by a very, very big margin. And that's been well documented. Now that that started to turn over and go into a bit of a sideways consolidation between October and November of last year. And then when interest rates started to move, we started to see a rotation out of the growth stocks and into value stocks. Now we've now had a period of some 4 or 5 months, where that has been trending down. But I think we're probably close to the end of this period. Whether we start to get growth outperformance again or not will depend a lot on earnings season. I do expect earnings season to be good for the growth stocks, and so I wouldn't be surprised to see this ratio turn back up again and growth stocks start to move at a faster pace than value stocks, because a lot of value stocks have been rising purely on the anticipation that in a post-COVID world that things get better, like travel stocks, for instance. But unfortunately, the reality is that a lot of these stocks are actually just poor businesses, and that as soon as any semblance of COVID comes back, as we're seeing at the moment in Europe with another wave of outbreak in Europe, then those stocks are going to get sold off again very, very quickly. So it's a very dangerous game to be playing the value stocks, the stocks that stand to be disrupted in the sort of world that we're in now. All right, let's take a look at the S&P. So the S&P finished, that's the overall monthly chart, just showing you where we are. We're in a secular bull market that started in 2013, this green patch here, and there will be some significant corrections. We could see another correction like what we saw in March of last year, or like what we saw in 2008. But I expect this overall secular bull market to last for quite possibly another decade. So that's the big picture of where we're at. But let's zone into to what's more important and happening today. And this is the S&P, and you can see we've finished at a new all-time closing high. Despite the selling of the last month, the S&P did fairly well because value stocks were going up, so they sort of offset the weakness in technology. And you can see that the moving averages are all looking pretty good. The 20 is above the 50, is above the 200, and the price is above all of them. So it's all stacked up very, very nicely. Okay. So let's just have a quick look at an overall market perspective. The periodic profit taking, I think, is probably finished. Nothing is ever guaranteed in the market, but certainly all the indicators that I've just gone through before would support that. So I think we're about to see a flip back to the aggressive side of the ledger. We're leading into earnings season starting up in a couple of weeks, so it all just fits very nicely. So the things to look out for. We often see a run up in the prices of tech stocks into the earnings results. You need to be a little bit careful because the ones that disappoint in any way on either the top line or bottom line, they tend to get hammered. But the ones that are going to do very well, those prices tend to be sustained. So the S&P ended up rising 1.6% across the week. The Nasdaq rose 2.4%. So that's actually the XLK. So the technology sector rose 2.4%. And as I showed you, we saw quite a decent reversal to finish the week. The US dollar is now clearly an uptrend. We're up to 92.77. The 10-year yield has just been fluctuating between 1.6 and the low 1.7s. And look, it could move higher to 2 or even a bit above 2 over time. But again, that will cause short-term disruption. The media will play it up. They'll tell you that it means it's all over for tech stocks, but it's not for the reasons that I outlined before. So those little periods that I'm sure we're going to see in the next 6 months are really buying opportunities. And the VIX, as I showed you, has settled back below 20. So there certainly seems to be a degree of calmness around the market. Turning now to Aussie stocks, the Aussie dollar was a bit weaker, of course, because the US dollar went up, and we've finished the week just under 76. Our index rose 1.7% for the week. That was mostly in healthcare, which had been sold off previously to that, and also some strength on Friday in materials stocks. And we probably expect our index will rise on Monday. The high growth small caps, whether they be in battery technology or mining stocks or healthcare stocks, that's really the go-to area in the Australian market. That's where all the significant gains and significant traction is being made. Just look at the US dollar. So you can see now we've clearly got a series of higher highs and higher lows. So we now have an uptrend in the US dollar. The 50-day moving average has now turned up. The price is above it. We've taken out the old short-term highs down here. So there's no question the US dollar is in uptrend, and and that's largely around the level of stimulus that is being put into the system is going to be good for the US economy. The yields are certainly rising faster in the US than they are in Europe, and so money is flowing from Europe into America as a consequence of that higher yield. So all the indications are that the US dollar will probably continue to rise. And of course, that's going to put a bit of pressure on commodity prices. Sorry, I just didn't look at the Australian dollar there. There we go. There's the Australian dollar. And turning now to our indices. So there's the overall ASX 200. So up a little bit on the week, but really it's just been going sideways for most of this year. Friday was good for material stocks. But if we look through the rest of the sectors, energy was flat across the week. Banks also flat. But most of the gains at the index level were made thanks to healthcare. We got quite a decent rebound in CSL, and that's pretty much the week in the Australian market. Turning now to precious metals, gold was lower by $12 to $17.33, and silver also under pressure, back down to 25.08. So the attempted short squeeze on silver fell apart. Only lasted a couple of days, and the US dollar is of course weighing on those precious metals prices. The selling pressure is likely to continue, and it may continue for many months. But stay alert for a turn in sentiment, because long term, the case for continuation of a bull market in precious metals is certainly there. At the moment, there are short-term factors that are weighing on the precious metals prices. Obviously, the US dollar is one of those, but there are others. At the moment, there's probably only one that I can identify that's a positive, and that's just the continued debasement of currencies by central banks. That has to be a long-term positive, but at the moment, it's just being completely swamped out by currency and by other factors. One of the other things about precious metals is that they do well when real interest rates are negative. So in other words, the nominal rate, so the nominal rate at the moment is of the 10-year in America is 1.7%. If real inflation is, let's say, 2%, then that gives you a negative real interest rate. Now, the perception at the moment is that interest rates will turn positive in real terms, and that is tends to be never a good environment for gold. But that's only a perception. And if you look at a lot of the inflation numbers are actually quite manufactured. They exclude the things that show that inflation is moving higher. So who knows what the real interest rate is, but that is certainly weighing on precious metals to a degree at the moment. So let's just take a look at those prices. So this is we'll look at the Bitcoin chart as well, just while I think of it. So a month or so ago, I postulated that we could get an ABC correction in the Bitcoin price. So this would be the A leg. We'd get a bounce to a lower high, and then we could possibly go down and retest the breakout. That was a possibility from a technical perspective. And all the comments I make on Bitcoin are purely technical. I'm not. I don't trade Bitcoin. I have very little idea about Bitcoin and what makes it move. So I'm not trying to be an expert here. The only reason that I show this chart is because I got a number of requests from people to do so. So I show the Bitcoin chart most weeks merely to comment on it from a purely technical point of view. Anyway, at the end of the day, the Bitcoin chart ignored completely what may have played out technically, and it went up, formed a new high. We got up to above $60,000, but we are now turning back down again. It's just all a bit of a washing machine at the moment. Overall, the moving averages are still stacked up nicely in order. The 20 above the 50, above the 200, and the price is holding above the 50. So at the moment, this is still a strong uptrend, and you can't look at it any other way. But buying the dips is an opportunity. So for anyone that's out there that actually trades Bitcoin in the shorter term, then this is a setup that you could trade, because you can put a very tight stop on the low. So you could put a stop just under $50,000. So that's probably all I want to say about Bitcoin at this stage. So this is gold on a weekly chart. So you can see we got out well above the channel, the long-term trend channel that started back in 2018. We got well above that in August of last year, and then since then it's been pretty much downhill. Even though during the first part of that period the US dollar was falling as well. So we're certainly in a corrective period in gold that's really washing out the excess that came in. There were 3 weeks here from the end of July to the middle of August where gold just absolutely took off from just under 1,800 and went to about 2,070. So that 3 weeks of excess is still getting washed out. If we look at the daily, you can see lots of very small range days. So there's no question we're in downtrend. There's no denying that. But we may be starting to form a bit of a base here. Silver also didn't escape, but is still looking stronger than gold overall. So if you look at the silver chart, look at the relationship to the 200-day moving average, the red line, and then if you flip over to to gold, you can see the difference. The 200-day moving average is now flattened out, starting to roll over, and the price is well below it. So silver is still outperforming. And if we look at gold stocks, this is GDXJ. I must admit, they're not looking too bad. And given that gold stocks do tend to lead in both directions, suggests to me that we may not see too much immediate downside unless there is another breakdown in gold, of course, which then changes everything. Other commodities, copper slipped a little bit down to 407, but nickel actually firmed up slightly to 738. So sort of defying the currency impact. The important thing with these commodities is not to get caught in the very short term. Just stay focused on the long-term trends, and in particular the quality businesses. You know, I get asked quite regularly, what are my favourite stocks in copper or in nickel or in lithium? The reality is that there are literally hundreds of Australian small caps that are in early exploration or development phase, and a lot of it, there is so much guesstimate built into the share prices that it's really, I think, pointless trying to have favourites in those sectors. To me, my favourite stocks are the ones that are going up, and that's the way that I look at the base metals and battery materials sector, is that it's really about what the charts are telling me, not about what the fundamentals might say. So focus on the quality businesses. Beware getting too overweight in the speculative ones. It's potentially a bit of a dangerous area, I think. Crude oil was a bit lower, down to 61, and we've got a real mix at the moment. We've got some transient factors. The ship that's run aground in the Suez Canal is one factor. We've got a lot of geopolitical forces at play. It's a very unpredictable area at the moment, the crude oil area. So there's the spot copper chart. We eased down just a little last week, and there's the nickel chart just starting to tick up after some profit taking. So wrapping it all up, the things to look for, you really want to be on stocks where the revenue growth is high and the probability of that growth is also high. And both of those sort of dwarf the current multiples. Now, some of these stocks in America are trading at multiples that at first glance look very high. But when you look at the revenue growth that a lot of these stocks are experiencing, 100% a year and above, then, you're entitled to pay a pretty hefty premium for that if it is sustainable. And that's the trick, finding the ones that are highly probable to continue. One of the things that helps the most are the stocks that have got a position where they can be a disruptor, and you want to be backing the disruptors and not be stuck in the disrupted in the environment we've got ahead of us. So clarity around your list has never been more important. You need to be very clear about what stocks you want to own. Some stocks will do extremely well, and others won't. That's just the reality. Portfolio analyst last week, we looked at iron ore, had a number of questions around BHP and Fortescue. We looked at oil stocks, and we also did some portfolio reviews. So it was a pretty good session in portfolio analyst last week. That's it for this week. If you'd like more information about what we do at Specialist Share Education, there is information on the website, and there's my email address as well for anyone that wants to communicate with me directly. So that's it for this week. Cheers.